Hello and welcome to another market commentary from StashAway. With us today, our Chief Investment Officer, Freddy Lim, and our Co-Chief Investment Officer, Stephanie. How are you both?
Hey, Philipp, how are you doing? Hey, Stephanie, good to see you again.
Yeah, good to see everyone.
Yeah, good to see all of you. Again, the group is back together. It's been a while, so happy to see both of your faces in our market commentary again. So lots to discuss. Obviously, we want to go right into it because we actually have quite a few topics. So we want to make sure that we cover them all. And let's start with the big the cat in the bag that's out of the bag, I guess. But the topic of inflation, we tackled it now so many times, but every 2 weeks when we get together, there's a new record being set. So again, US inflation data in May still driven up. Again, we're still near 40-year highs. What's your both of your takes on this? Where are we going from here? What's the impact you're seeing already?
Stephanie?
Yeah, I guess we've seen another very, very high print for the latest April CPI number, and that was actually the surprise on the upside as well versus kind of analyst expectations. And if you dig a bit deeper, so there's 4 components to the headline CPI. Number 1 is energy. Number 2 is food. So these 2 are more volatile components, which the Fed typically kind of disregards when they set their policy directions. On that front, actually, there has been some improvement. So if you look at energy, it's actually already contributing negatively to the headline inflation number due to a very, very high base last year. And it seems like, given kind of the stability of the recent oil prices, that number will continue to trend down. However, the Fed is more concerned about what we call the core inflation. So core inflation also makes up of 2 components. One is goods inflation. So these are inflation for like things that we buy, for example, like your mobile phones or like furniture, etc. And these have actually also come off a little bit. What's more concerning, however, is that the service component of the CPI, which have 30% weight in rent, that has kind of continued to climb, and that is what the Fed is mostly concerned about. If you look at rent CPI, for example, in the United States, right now is trending at around 45%, and there's no signs of that slowing down. That relates to, I guess, why the Fed has been hiking interest rates very aggressively. So, for example, when they hike the short-term interest rates, that gets fed through to the mortgage rates as well. And that is very, very important for setting home prices and also rent prices. So the 30-year mortgage rate right now sits above 5%. That was up from around 3% at the beginning of the year. And that represents a very, very significant increase in the interest payments of home buyers. So the Fed, what the Fed is trying to do is to actually slow down the housing market in the U.S. and by that and slow down kind of the rent inflation and service inflation. So we'll see. How much it takes, but the Fed in the latest communications has said that they will be very, very determined to keep prices stable. So this is actually the interest rate is one very, very important conduit for them to do that, and they also try to get unemployment rate up. So their view is that because of all the supply chain constraints, right now the world is facing inflation. So they want to kind of put down, kind of dampen demand such that they allow time for the supply chain issue to be resolved, thus bringing things into balance. So we're going to see still quite aggressive kind of Fed policy on tightening, at least over the next few months.
Yeah. And with that being said, we've been seeing this already. The stock market still keeps to be pretty volatile. I think we ended last week with some good days, like back-to-back good days, just to wake up this week. Today we're recording this on the 19th in the morning in Asia time. But obviously, it had one of the worst days in I don't know how many years yesterday in the US. So bonds were taking a hit at the start of the year. And so people were a little bit worried, is this not working anymore, having bonds in my portfolio, right? Because they're going down just as much as, stocks are going down, but it seems to be leveling off now. Where do you see this going? What does that give you as an insight going forward?
If I may chime in, the fortunate thing about the Fed is they committed to 50 probably at each meeting, but they could have done more, right? There were talks about 75, but officially Jerome Powell ruled that out. So, and get criticisms from some people as well, where they say, well, you're not really fighting inflation enough. So there are people in that camps. But in my opinion, going too far also risks breaking the economy, right? At a very, very complex times like ours, right? With Russia-Ukraine invasion, disruption of supply chain also coming from China lockdowns, and there's so many things happening. I personally felt that the Fed has been quite pragmatic. They are clearly behind the curve, but they are also aware they can't break the neck of the economy right now. So the 50 was well telecast. Hence, you're starting to see the bond markets getting close to this full pricing, getting close to a stability, right? And that's when hopefully soon, if some elements of the CPI start softening, you see a very sensitive bond market in a positive manner. Right now, we are not there. It's too early to call a turn, but the stability has been very, very noticeable, as you have mentioned.
I guess the market has been very, very squarely focused on inflation for the last 6 months or so. And given the Fed's rhetoric, I think there's also some concern about slowing down of the U.S. economy. So in that kind of regime or in that scenario, bonds should be able to provide some diversification benefits again. Because in the past 6 months, we haven't seen that, right? Bonds actually went down with equities. But in a kind of slower kind of economic growth scenario, then bonds become the go-to safe haven asset again.
Yeah. No, great. And then I want to move on from that, because I think now let's talk a little bit about our portfolios, because we get kind of a lot of people asking, what should be my approach investing into thematic portfolios? Some thematic portfolios have taken a bigger hit than maybe the market have. So how should people, when they think about adding a thematic portfolio on top of their core, how should they think about doing that? And what kind of what are you telling these people in terms of risk taking and things like that?
I think when we launched those thematic portfolios, they're one of the very first things we talk about is go back to your financial plans. We're giving you access to a particular sector or area that is more concentrated. If you're worried there's a bunch of risk level you can find, but they are the same, not the same, they are still relatively concentrated versus the global portfolio, the flagship. So it's part of a financial plan. You may say, I want to have 3% in something or 5% in something. That's completely fine, but not 100%. So I think we need to go back to that, number one. And two, if you have high conviction in the team, that shouldn't worry you as long as you have the right allocation from your plan. I have 5%, this is what I'm sticking to over the long term, that's fine. Even if it dropped by a third or even more, this is a small part of the overall. It's unlike the flagship. So I think that's the first thing. Second is maybe review the risk level. If you think the bond markets, like Stephanie said, is sort of stabilizing and any bad news henceforth, maybe protective assets will actually function again. So this is a time to also revisit, should I adjust risk level from a very, very high risk to something more balanced to benefit from that? So that is an opinion that you really need to have a think. But as long as in the first place, your allocation is a well-designed one as part of the overall plan, that shouldn't concern you. What I said about the bond side is an adjustment to it, the risk level. Right. I'll stop.
No, exactly. I agree. And we've talked about this so many times. We do it in our seminars all the time as well. If your plan hasn't changed, right? Keep steady the boat, right? And I think also tune out all the noise. There's so much noise right now. Every day there's more noise. And then, if you look at it, like you zoom out a little bit and everything is like, it's okay. We get through this. We've been here before. Right. So I think, just, taking a step back in times like this is also good. Don't, if your plan hasn't changed.
It's
right?
very, very hard to trade. If you look at the market on a daily basis, I mean, one day the S&P goes up like 3%, the other day it goes down 4%. You won't be able to sleep. So just have the right plan, have the right SRI, and I think kind of longer term, are these like sectors that you're very excited about, or are these themes that you're very excited about? Have the right risk.
Yeah, exactly. And if you have ever any questions, feel free to reach out to our CX team. They're really good. They try to answer all your questions. You can always send them also questions to ask all of us. So we'll be back obviously in a couple of weeks, and so we'll collect those questions and get them answered on the air here. With that being said, we do have one quick shout out for a webinar coming up on Wednesday, the 25th of May. That's next week at 6 p.m. local time, Malaysia. It's called How to Plan for Your Retirement. So if you're looking to get some insights on how you should plan for it, what kind of the tools you can use and programs you can make your retirement plan up for, is Wednesday 25th, 6 p.m. local time. As always, the sign up is in the show notes below. Thank you both, Stephanie. Thank you, Freddy. It was good to have you both together this week, and looking forward to chatting with everyone again soon. Have a great week. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.